Jerome Powell was the talk of the street. He was the dictator of the market. He laid on some dirty talk to us today. The US Federal Reserve has decided that they are going to raise interest rates 25 basis points today. But what's more important is the quarterly guidance that we got. We hadn't had since December. We have again, and a lot of the individual commentary that we got surrounding, specifically surrounding all of the banking crisis that we're going through right now, and how raising rates is actually going to, well, in some ways, holy crap, I got some long hairs here, guys. Is how it's going to affect the long-term and short-term and medium-term turnaround of the economy. And effectively, we are going to enter a recession. They said that today. Well, he was very unsure in his wording of how we were going to engineer a soft landing. What we'd love to hear is, Jerome to get on there and say, hey, we know we're headed for, a nice soft landing. Everything's going great, which is more like what we had last time he spoke. This time it's like, we're going to do whatever we have to stay resolute on our fight against inflation. Thankfully, the banking crisis has created a credit tightening, which is doing his job for him. They're still hiking. They have to continue to hike. In the report that came out today, they said rate hikes with an S, meaning more hikes to come, probably two. The market is currently pricing in a June or July rate decrease. I think the market is overly optimistic. I think that, in general, most investors are overly optimistic. That said, you go on Twitter and there's so much bear news, there's so much bear negativity that I don't think we'll see a really big pullback again because there's so much bear energy. If we had everyone being bullish and then, the collapse, well, then there would be a big drop. Interestingly, today, I closed my shorts out. I watched the Fed speak. I watched them deliver the guidance. I read the same report everyone else did. And at 2 o'clock, I thought, geez, this looks pretty bad to me. Like the terminal rate is going to be over 5.1, and they're talking about 2024 before any rate decreases. And people keep hoping the Fed's going to pivot, they're going to U-turn, especially with a banking crisis where as they raise rates, they collapse the banking system. The problem is exacerbated and made much, much worse by raising rates, and they continue to raise rates. There was a chance that they were going to not raise rates as a direct result of what we've seen in the last 2 weeks with several of the regional and mid-sized banks getting close to insolvent, and some like SVB actually going fully, run on the bank, taken over by the Fed, collapse. And that was interesting because we had kind of hoped that the Fed might, the bull in us, the people who want the long-term growth, they want the short-term bounce back. We want to see rates come down because, again, what happens when rates go up, right? Well, one, the cost of borrowing goes way up. And that translates to lower profits for companies, translates to individuals having higher housing costs, higher cost to finance their cars. Everything just goes up in cost because those things have to be passed on. So if your mortgage was $2,000 a month, now it's $3,500 to buy a house today. That results in needing to collect more rent, which should really lead to more inflation, right? Typically what happens is when you have inflation for a long period of time, like we've had now, it's no longer transitory. We've had high inflation for coming up on like a year and a half, 2 years now. So it's pretty sticky. Further, most unions and employers are being lobbied by the unions and by the collectives of employees asking for higher wages. And that directly entrenches the inflation we've had and makes it very difficult to go back. So going back is not going to happen. We're not going to get deflation. The 20% or so run we've seen on prices of everything, food, all of that, services specifically, we might see it in commodities. We might see, lumber and certain commodities go back down in price, again, directly resulting of the crushing and expand, like you normally have an expanding money supply, but lately with raising rates and not as much stimulus into the economy, we've seen a contraction of the money supply, or at least not near as much printing as we had seen in the last 2-3 years. Excluding the fact they just printed $300 billion for the FDIC bailout, which will effectively create additional money in the system. That money should have been lost, right? And now they have to print new money to make up for the money that was lost. But anyway, so that, excluding that, like barring that, they've been doing a really good job the last 6 months of getting inflation under control. The readings are coming in better and better and better. And we're seeing, some really great traction by way of beating down core inflation and a number of other things. So that's all positive news. That's what we want to see. They're the resolute and the conviction to bringing inflation back down to 2.5% by 2025 now is their forecast, by the way. That means that 2021 to 2025 is a 4-year period of way higher inflation than we're supposed to have. The good news for that, I guess, is if you use leverage in your business in any way, meaning you have quality assets that you've borrowed debt against at a fixed rate of return, appreciation over the long term will always beat out inflation. Over the short term, it won't. There'll be pain right now. As rates are high, it's artificially suppressing things. The entire financial sector is looking for liquidity right now. So in the banking side, they're going to dry up their credit terms. Small and mid-sized banks will not be lending. They will not take on risky hotels to fund. They will not fund your mortgage. They will not give you a line of credit for your business. They're tightening up. And that tightening up is doing Jerome's job for him. Not only is it way more expensive to borrow right now, but you actually can't get any, even if you want money to go and buy the dip. It's very difficult to get. So the credit is tightening up. That will lead to less employment opportunities. That will bring unemployment higher. That will lead to more job loss and more pain. We'll eventually hit a recession. And there's been some key dialogue we've seen today that a recession is coming. Again, because of the importance of the Fed, kind of has to choose now. We were talking about for the last year and a half in this live stream. I've been, at least once every couple of weeks, I've talked about trying to land this plane between the rock and the hard place. And I think that we're the rock and the hard place being like inflation running out of control and having no price stability at all. No price stability means you can't do business in that market. If you don't have price stability in a market, how do you bid on a contract? How do you can't do business. You can't quote on something when you can't be sure of the input costs. So you need price stability for an economy to function. So that's really, really important. If you don't have that and inflation runs wild, it's disastrous. It crushes everything. It kills all income, fixed income. It kills everyone, every sector. It's just horrible for the most part. Now, on the other side, you've got the tools they need to combat inflation are like reducing money supply, increasing the cost of borrowing, and then tightening up liquidity, like specifically with the banks, forcing them to lend less and take less risky propositions on. So that's a big piece, I think, that when we're thinking through how this is going to play out when it comes to the stock market, there'll be a pivot when we know inflation has been fully beat and when we see economic data is bad. So that's when you want to buy the dip. Ideally, you just continue to buy the dip constantly. You never give up. You always buy small amounts of the index. Today was a good example. I closed out my short position, which was stupid. I was getting crushed. I had a pretty good short going into the call. I heard Jerome start speaking. The market was rallying like plus 1%. We were at 315, which means the NASDAQ was up 18.3% on the year to date today. It closed the day out today up 14.5%. So we had almost a 3.5% reversal on the year to date performance in the span of an hour and a half. And I closed out and I bought the dip a little bit. And I thought, well, you know what, just gonna keep running. I'm gonna buy a little bit. And I bought a little bit. And of course, just as I closed my shorts out and bought a little bit, the market just crushed from like 314 to like 306 on the NASDAQ QQQ. I was like, oh man, bummer. So I had really bad timing today. It'll be fine. Nothing moves straight down. There'll be a bounce. So I'm going to resume my shorting of the market. I read that report and I was short, but I'm like, man, the market is not interpreting this in the same way that I am. What am I missing? Like there must be something I'm not seeing because, the funds are all like rallying right now. I'm like, you don't want to be on the short side of a rally like that. And so I just thought, I'll cut it. But I'm going to re-engage my shorts tomorrow, so that's what I'm going to do. But in general, we know that we buy the dip, we hold, and over the long term, we always win. So for the long period of time, you don't want to be short. You want to be long the market. That's the general consensus. That's the good advice. You can try to play in between it, but typically 99.9% of the time, if you try to trade the market, you will lose to the market net of fees. So just keep that in mind, guys. It is scary times ahead. We do have more, the economy is going to be in some great pain, but the stock market might actually pivot around the time of the most pain. So it's an opportunity. And so we're looking for that bottom. We're looking when, we're seeing like Amazon and Meta and lots of companies are laying off employees like crazy. That's a good thing because that's going to bring inflation down. Once inflation's down, we're back to a bull market again, which means we can lower rates back down, which stimulates everything. We can borrow to grow. And when the cost of debt is like 2-3%, I mean, we can just, there's just so much you can do with leverage. It's more risky now. It's difficult. It is hard to borrow at 8 or 9% right now and guarantee a profit in a declining market. So I'm excited for the next bull run. I'm trying to align myself well to that. I continue to buy. Despite being bearish, I continue to buy properties. I continue to do what I do in my real estate business, but I know that I'm not getting that headwind in my sale of an appreciating market. And instead, it's like I'm fighting the wind right now. So just be cognizant of the fact that seasonally speaking, this December may be a better time. Next December may be even better time to try to time real estate. Again, I could be totally wrong. The Fed this summer could come out and say, hey, we're beating inflation. Gasoline prices are way down. That's dragging inflation down. They've changed how they're calculating inflation as well now. As an example, like the amount of spending that the average person spends this year is how they're going to calculate it. And so if, as an example, there was a post I shared today, if the average American spent 4% of their budget on steak, then they would weight that at 4% traditionally based on the previous 2 years. Now they're going to base it on more recent data. And they say, hey, well, it's a recession now, so people are spending 2% on steak, so we're only going to weight steak 2%. Which is like, in a recession, people don't spend as much on luxuries, so you're basically readjusting the CPI to help you against things like meat that are rising out of control more quickly or faster than some other inputs. So it's interesting to see how the CPI plays out and how inflation kind of the real inflation and the posted actual CPI data kind of plays out in the next couple of months. It's really, none of us are 100% sure, but I think what we do know is that real estate, like looking at every single real estate crash in the last century, and like I'll use 2008 as an example because it was the biggest real estate crash, but it was the same in the 80s, it was the same in the 70s, it was the same in the 90s, and the 2000 era. In fact, like just while I'm on this tangent, in Ontario, specifically in Canada, from 1990 to 2003, there was no appreciation in Toronto. It actually didn't even beat inflation for 13 years. The price of housing was flat to down for a decade. You could hold a house for 10 years and make nothing. So there's a lot of real estate agents you'll follow online. They're like, just buy real estate, like you'll always win guaranteed. There have been segments in history where that isn't the case. And that was the reason for that was the high inflation battle with high interest rates. And it kind of crushed things a little bit until tech innovation came and carried new improvements of a new age into the mid and late 90s, which kind of started to carry the market into the 2000s. And immigration was a big play in Ontario as well through that period. But we could definitely see times where we won't see that crazy appreciation. And I think it's important when we're predicting how this plays out. You go back to 2008, 2007, let's call it. 2007 was the last time we saw the Fed funds rate and the Fed terminal rates at the rate that they're on now. As of today, we got another 25 basis point hike today. The market's pricing in 5.1% as the terminal, a little bit less. It may end up getting higher. They may deliver 2 more 25 basis point increases before they then retreat back down. But interestingly, I think they've gone harder faster this time, and technological advancement will allow us to get through these cycles faster. So that's something to keep in mind as I tell you this. But in 2007, when things peaked, real estate bottomed. People think real estate crashed in 2008. It did. It had like a 25% decline, and some markets had 35% declines. Florida had a huge decline. At that time, it was being oversold, though there was different market conditions. There were a lot of people who had 105% loan-to-value mortgages, so they had negative equity in their properties. We don't have that same lending practice today. So for that reason, we won't see as big of a drop. But my point is this. People thought that 2008 was a recession. If you actually bought real estate in 2008, by the end of 2011, 3 years later, if you had bought the dip in 2008 when everything was going like to shit, and you just bought market retail price, you made nothing in 3 full years. By end of 2011, real estate actually bottomed. So it continued to drop for 3 more years, very subtly. I think we will see a similar pattern here in a quicker amount of time. So I think it's very possible that the market is slightly flat, slightly down for the next couple of years until we see rates retrace back down. So it's possible we see the same thing and the same pain. So just keep that in mind, guys. If you're buying, continue to buy. If you find a great deal, take it down. If it's cash flow positive, buy it. Because again, the market can always run, and over the 5-10 year period, you always win. You look back, you're usually always going to be good if you bought smart. Only exception is in Ontario for a decade around Toronto. It didn't actually do that. And for 10 years, you could buy the same house, renovate it, and make nothing for like a 5-10 year period. But that's a rare exception. There were other macro factors that I don't think are at play this time. Also, I think that something to be cognizant of is like ChatGPT as an example. Some of the technological innovations that are changing the way that input labor affects how we understand an economy. And more, the input of labor is less and less valuable, and capital is more and more valuable in our society today. And I think that these new innovations may allow us, despite having a really difficult labor market coming forward in the next few months as the rates continue to hike, and the pain of that is felt, right? Like when you punish a business today with 25 basis point hike, as an example, and all the rest of the hikes that they've given, that translates to more expenses for that business. They don't make decisions on that pain typically for like 3 to 6 months. So we're not gonna feel the effects of a lot of this. It's lagged, it takes time. And in real estate, it takes even longer, because by the time you realize you're underwater in your mortgage, it takes 6 months before they can foreclose on you. It just takes time for all of this to go through. So these houses don't hit the market for like 6 months to a year. And then once they hit the market, then we can use them as comparables once they actually close and sell to the new owner. So it takes time for this to play out. People will use the available credit they have before they default. It will take time. They will hold out thinking that there's, they won't capitulate initially, right? When they find out the rental property has dropped to the point of, break even and they have no equity in their property, they're gonna keep holding it for a little while. But if things stay bad for long enough and they have a bad tenant, something happens, more of those people who are holding, waiting for a bounce, that don't get the bounce, because real estate takes a long time to bounce, I think some of those people will come onto the market next year. And so my thought is this. I continue to buy real estate. I love real estate. I continue to buy stocks. Again, I have a lot of great companies that I really like. Just cautiously. I'm not balls deep, highly levered, all in. I'm slowly buying in. I'm trying to buy way under market value. When I'm running my numbers, I'm pricing in depreciation. I know investors are sending me, I'm still getting people sending me deal analysis where they have appreciation at 6-7% on their formula. And it's like, you might get that over a 10-year period. But the next couple of years, I wouldn't be banking on any appreciation. I would set that to -6%. How does that play out, right? So that's important, especially on deals that aren't good. There's a lot of deals that aren't good right now that people are still taking down. And there's a bit of a run right now as we go into the spring market. There'll be a lot of FOMO, fear of missing out. You're going to see a lot of that. If realtors are going to be posting like, you're missing out, the market's up. We should see a tick up, actually. Real estate towards May should jump about 7-8% between May and December, January. End of December, early January is the low point for real estate. I posted on my stories yesterday a chart of London, Ontario, the L-Star market. So London, St. Thomas area, like my whole area where I pay for data, and I have the actual data going back like 20 years or whatever. And you can click on the chart. This is what real estate prices look like. They look like this, right? What you see is that you click on every low point, it's always December, January, and every high point is always either May or closing dates after May. So you do see like a 10% retracement every year. So if you, all things equally, the seasonal adjustment for real estate, and every market's different. Arizona, as an example, in the winter has their peak because all the snowbirds come, they drive the price up. So it just depends, right? But in colder climates especially, where things aren't as nice and people aren't as likely to go out, typically what you see is people are moving in the spring, so they buy in the spring so they can close in the summer, so they get their kids ready and they go to school in August, September, so they want to be settled in their house by July, August usually, and no one wants to move around Christmas. So you won't see a lot of transacting. Even the realtors all go on vacation for 3 weeks. Sometimes you'll call listings and they don't even respond back to you for a week and a half. I mean, that's opportunity right there. If no one's out there hunting and you're the only person hunting, any inventory you could negotiate at a great discount. So it logically makes sense why the December, January slowdown exists. I've talked to a couple of realtors about this and they're like, it just doesn't exist. The data doesn't show that. I'm like, go look at the data. It 100% shows that. You can 100% buy the same house in December versus May at an $80,000 difference on a $600,000-$700,000 house. 100% it happens. On average, on aggregate, look at the median data, look at the average data, it 100% is true. So if you're worried about fear of missing out coming into this May, don't jump into some property that doesn't make perfect sense. Don't just go out there and chase something just because. You may find a better opportunity this December, this January. So this November, December, January, make sure your hunting hat's on and you go and look and see what there is. But I think there's more opportunity to come. That said, I run a real estate business, so you're gonna see me not always practice exactly what I preach. Remember, we can't time the market. I try to time the market, but none of us are perfect at timing the market. And what we know is that long-term, the market always moves up. So if you were to short the market over a 5-year period, you'll almost always certainly lose. So do not play the bear long-term. I'm short-term bearish, medium-term neutral, and long-term bull to the moon. That's, I think, the most prudent way to operate through a bull market or through a bear market. In a bull market, you just want to be bull all the time, right? Like short-term, buy as much as you humanly can. That's how it was the last 5 years. And so anyone who is, and most entrepreneurs I meet are extremely optimistic, gung-ho, like ready, aim, fire. That type of personality does really well in entrepreneurship and real estate and business. Just in general, that type of personality thrives. That type of personality doesn't thrive so well in a bear market because they load up to the tits and then they end up, they got a Dave Ramsey moment where they're callable debt, they can't sustain it, rates go up, they didn't plan for that, and then they end up bankrupt, right? Which is what happened to Dave Ramsey, why he hates debt so much, in part. Not to shit on him, but like he's just an example of there's hundreds of other real estate investors who are suffering right now, and a lot of them bought not looking at fundamentals, looking at like the last year went up 20%, so this year will too, and they bought at market, not for cash flow, with an exit value that was unrealistic, especially in a declining market. Like you can get wiped out in a declining market. It can be pretty brutal. So don't be that. Don't do that. Be smart. Look at the data. Don't take risks that you otherwise wouldn't need to take. I think it's important too during this time to be also cognizant of the fact that this is a once in a decade, opportunity. Well, in this case, we had COVID, so we're gonna get twice in a decade. But there might be an opportunity to position yourself well towards the bottom of this if you're fully deployed, where you could make returns that could make you millions. So this is an opportunity where we don't want to sit on the sidelines with just cash. We want to be looking for opportunities, but we want to be critical about the opportunities that we're taking. And if you bought Meta when I was telling you to buy Meta in December or November when it was $98 a share, now it's, let's just say it almost peaked at $200 a share, and you made 100% of your money, take profit. In a bear market, you take profits. You're like, I'm up 100% on this one, you harvest. You take profit, you look for another opportunity to get back in. So don't be afraid to take profits in this market. If you've done well, enjoy that. If you've bought a property and it's above water, sometimes it makes sense to sell that and buy another asset, because you might be able to sell your property for using an old comp from 6 months ago to get a little bit higher price and then negotiate a better deal on the same property, like not the exact same property, but a property that's very, very comparable for less. And so you could end up taking one asset, selling it, and buying two more. The 1 for 2 is a strategy I've used so many times, where I'll buy a house for 200, I'll put 50 into it, I'll sell it for 400, and I'll buy two more for 200. I just turned one house into two houses. I do that again and again and again, and that's how you use, like cellular growth, right? You split, divide, and conquer. That's how you grow. And so I think that, I'm of two minds on it, but I'm cognizant of the fact that I need to be careful in my analysis and making sure that I'm buying the right deals. And that's how you move forward well in a time like this. Thankfully, we've seen quite a bit of, I'll get to the Q&A in a second here. I see some stuff popping up. I really think there's a lot of opportunity. So don't let the fear of these rising rates, keep you from doing, you don't want to be paralyzed. Deploy your capital, but don't go crazy with leverage, I think, in these environments. And if you are going crazy with leverage, make sure it's against a quality asset that can carry the debt. That's super important. Then you're fine. You can use some leverage. What's up, DW? Daryl, how you doing? Good evening. Stickman says, when do you think real estate will bottom? I don't know. Seasonally speaking, we should see real estate bottom in a December, like an October, November, December, January time period. So has it already bottomed? I don't think so. Real estate is very lagged. It takes a long time. We've seen more rate hikes. We are seeing more rate hikes right now. So the bottom should follow 6 months from the last rate hike. In fact, when the Fed starts pivoting and rates start coming down, sometime after that, the comps will begin to reflect. You will see an uptick in demand pressure at that time. When rates start to come down, what most people do is they want to wait, because no one wants to lock in a rate of 5 if they believe rates are going to 3. And so what we'll see is a lot of cash buyers start engaging in the market. See people start competing, but we don't have the comps of that increased competition and all those buyers jumping into the market for like 3 to 6 months out typically, because it takes time for the transaction to happen, close. Then we can use that as a comparable sale. So it takes time for, like, people are worried about, like, what if I miss the bottom? We're gonna know when the bottom is, when real estate, it'll be hard to predict perfectly, but we're gonna see, it's gonna be when rates are falling. So at that point when rates are falling, as they come back down into the 3-4% range, that is when we will see real estate just rip. Until that point, real estate will stay suppressed. It cannot rip. You can't have a rip like we've had with debt at 8%, 9%. There are mortgages with lender fees and everything at 9 and 10% in the US. You cannot get a major rip up in price while that's happening. It's just too much pressure. Real estate is too debt dependent. So if you're worried about FOMO or fear of missing out, Like we'll probably stay in a relatively flat market, barring seasonality of like your 6 to 10%, depending on the market that you're in. So obviously try not to buy in the peak of May if you can, unless it's off market, in which case you're not competing anyway, you don't care. Different ball of wax, right? But try to avoid competing, especially in these markets where there isn't as many offers, but we're going to see some heat in the spring. Just, it naturally happens. People have been waiting. They're going to get out. They're going to buy a house. They've been waiting from COVID, some people. So those people will get in there. They'll buy a house. So there'll be some heat. I wouldn't get involved with that heat. I don't think that there's any, you may actually be overpaying, and there's a higher probability of flat or even more downside risk to buying some of these assets right now. Like if I'm even Meta, I love Meta. It's an amazing company, but $200 a share, I mean, there's a lot of pain potentially ahead, economically speaking. And this may not age well if we go back and watch this video, but though my price target for Meta is $300 a share in the next 5 years, at least, I think that there's a potential that we pull back to 100 again on that company. So, I mean, it's a real possibility. So there's a lot of risk for not so much upside. Like your best upside is like 33% upside, let's say on Meta as an example. In real estate, if you're buying a property right now, I think that your best upside in the next year is probably flat or like 5 or 10% appreciation maximum. They're more likely to lose money. Whereas when we were investing in 2019, there was no 2020 coming out of the COVID pandemic. It was like, there was no real reason real estate should fall. I mean, other than like unaffordability, there were no really good reasons. Money was free. A 2% interest, who cares? You could fix in back then, you could fix in for 30 years in the US at 2.5%. I mean, if you fixed in then, no problem. There was no bad purchases. There was very few bad purchases back then relative, right, to the rates now. And so the high interest rate and the tightening of credit right now make it really hard to borrow and really expensive to borrow. And real estate is a borrowing business, so it will just keep, there's still supply demand imbalance. I get it. There's too many people immigrating and not enough housing available. So there are trends that are good for real estate that will continue to push the price up. Inflation's run pretty high. So eventually real estate will outpace inflation. It has outpaced inflation big time the last 5 years. So we have some catching up to do, but my thought is this, that you aren't going to miss out big time by waiting. That said, what you don't want to do right now is just be sitting in cash. When I say cash, I mean like deployed in something safe, like a 5%. You can get almost 5% bonds right now, 4.8% pretty safely. Those are places you can park it right now and get almost like it's a risk-free 4.8%. Having it in the bank though, a bit more dangerous. Like if you're not in a major bank, be careful right now. If you're in like a small or a mid-sized regional bank and you're under the FDIC limits, I mean, you're probably okay, but I don't know. For me, I'd want to have that cash deployed. With inflation running where it is, I mean, you're just losing money. Have it doing something. Don't have it just sitting in cash. So that would just be my advice. Go deploy it in something. Keep it parked. Make some money in your money. There are lots of opportunities right now. You can park into real estate where you can make a 10% return pretty safely. And so you can go just park your cash, make 10% return, and wait for the opportunity to buy the right thing. You can always refinance that capital out of that property, right? If you went and parked cash on a house right now, it's one of the few times where I would say it can make sense to not have debt, is the market we're going through right now where it's really expensive debt. And you don't want to lock in a 30-year mortgage at 9% right now. It's just ridiculous. Like if you're in the US right now, I don't know why people are locking in that kind of debt at those rates. It just doesn't make sense because the average properties aren't cap rating enough to make it make sense. So, but then you take that property, and if you want to go buy properties, you go throw a mortgage on it, 80% loan to value. Boom, you got most of your capital back out. If you bought a property that needed some renovation, you might be able to get 100% of your initial capital back out and go buy some properties in the bottom of the market. So that'd be something I would kind of be working on in my back pocket. I would have financing ready to go. And if you see the right opportunities, be ready to lever that asset, take that cash and go on to more opportunities. So as rates come down, that will be the time we want to go really hard. But continue to buy now where stuff makes sense. Don't be afraid. Do not be afraid, guys. The minimum wage increase you posted on your story is interesting. More inflation may come from that. Well, good point. I did post that. The federal minimum wage now increasing in Canada to $16.65 an hour Canadian. In Ontario, it's $15.55 an hour for every job in Ontario. The federal jobs only apply to certain jobs, like the federal minimum wage. But the Ontario minimum wage is going up. So some people don't know that. I shared that on my stories and people are like, what? Minimum wage is going up 10%? I'm like, yeah, minimum wage just forced 10% up. Guess who the majority of the bottom class of renters are? By the way, something like if you look at the median income of a homeowner versus a tenant in all the smaller cities, tenants have much, much, much lower income and assets than people who own homes. So the majority of your renter class is working a job making $17 an hour. They're going to directly feel this. If the guy at McDonald's is making $16 an hour and they're making 17, why would they and they're a skilled job, they're going to go to their employer and be like, hello, I'm going to just go get a job at McDonald's. It's like the wage inflation will follow as a direct result of this. So this is a bullish signal for Ontario specifically for in Canada, where they're not doing this in the US and a lot of states, but in Ontario right now, they're pumping wages up. And union people at the education board negotiated a 45 or 50%, I think it was, like almost a 50% increase on their wage over a 4-year period. That's huge. You don't think all those unions fighting for those crazy wage hikes? What happens when you give people more money? They spend more. They bid more for the apartment. They bid an extra $100 a month to get the unit. So it drives up rents. So we will see some inflation as a result of this. It will take time, but we will see inflation as a result of this. So I don't know. There's so many things, right? Like the banking crisis and the liquidity crunch should drive down a lot of demand to buy stuff. But at the same time, if you're paying people more money, that would drive inflation up. Higher interest costs should drive things down, should force unemployment to rise. And so that would be more pain for people. So there's so many factors at play. It's hard to kind of map out, but these are all things to think about. So there are some bullish things, there are some bearish things going on. Overall, I would say that my opinion on real estate is that, again, I'm long-term super bullish. I feel really good about owning properties for the long term in states like Florida, in places like Ontario, where you're not a long-term. In Ontario, I hate long-term rentals. So if I get a long-term rental, I immediately I like to buy the property vacant, ideally. But I buy it vacant and put it on Airbnb. I would do a short-term furnished rental thing, even get a hotel license or something. That's the way to go because you're in full control of your asset. If you're renting in Ontario, we're moving towards, like, even the justices at the tribunal, most of them, they're all previous, they previously have backgrounds supporting tenants. They're hired by tenants to support the tenant in finding ways to stay longer and not pay rent, and defend the tenant's rights. And so it's just, the whole system's pretty bad. I never want to go to the landlord-tenant board again. When I go, I often lose. Even if you win, you lose. If you get a judgment to evict them, it can take a year from when they stop paying rents. It's just a horrible system. It's a lot like California and Ontario. So for that reason, I love real estate in Ontario. I think the fundamentals are super strong. I just don't want to have a shitty tenant there. So if I'm going to buy a building, I'm going to do a student rental because my students aren't staying. I can change the rent out every year. Maybe a student stays 2 years max. They move on with their life. You get smart, determined students that are just there temporarily in your city to go to school. Most of the time, they don't want to stay renting a room. They want to get their own apartment. They want to move on. And so when you're targeting that class of people, or if you do have to do long-term rental, target rich. Just in general, target rich people and set them up. You can now set up a program in Ontario where every time they pay rent, they get a boost on their credit score. You make it there's mandatory programs well, they're not mandatory, but you can make it mandatory. And every time they report, you say, hey, every time you pay rent on time, you can get a nice little check mark on your credit score. If you don't pay, we're going to destroy your credit. It now shows up. And so someone who has an 800 credit score, like a super excellent credit score, they're going to care. They have something to lose. If they have lots of assets, you could sue them if they don't pay. But if you rent to a bum who has just their car as their asset, or like they don't have any assets, which is like, by the way, the majority of the renting class. Most of them don't have much by way of assets. They're ass to mouth, they're making 40, 50 grand a year and the money that comes in goes out, and I feel for that. But from a business perspective, why would I take the risk? Look for a tenant that has really good quality income. Like the upper class tenants, I had an upper class tenant once get bed bugs and they got rid of it themselves. They went and hired a pest control company because they were embarrassed to tell me. They had status. A bum tenant can't afford pest control and they're bugging you. And they brought the issue in. Pest control, like certain pest control issues are landlord issues, but bed bugs are brought in by the tenant, 100%, unless they were in the building already. The tenant has to bring them in. They go to a friend's house that has bed bugs, they bring them back on their pants or their gym bag, whatever. It comes back to how the tenants are living. And a good quality tenant with something to lose is super, super important. You want to do business with people, and because as a landlord tenant, it's a business relationship. You're providing a service, ideally you're providing a really nice place for them to live, and you're servicing that, you continue to maintain that property. It's Ass to mouth. So Brendan showed up. The ass to mouth thing is like, all that means is like your paycheck to paycheck. The minute you get money, it's out again. You're ass to mouth. You're always trying to get a little more, trying to keep the cycle going. And most people are living that way, unfortunately. Like the average savings rate is like 3%. It's embarrassing how bad people are with money. And you know what the root of, people hate capitalism, but like, don't hate on capitalism, hate on consumerism. The problem is consumerism, not capitalism. You want to punish. I think the real issue lies in that humans are generally very difficult. They have a difficult time with managing and delaying gratification. And the marketing schemes that they're, coming up with in these marketing departments are really good, actually. Like they can create good FOMO that you almost have to buy that app, or you want to buy that new phone, whatever it is. They're good at getting to sell you that experience, that service, that good. Unsubscribe from it, and your problems in life will mostly be solved. Most of it comes back to subscribing to consumerism. And if you can unsubscribe, the idea of like minimalism, where the less stuff is better, you'll have a much better life because you don't need to spend all of what you make. If you work a full-time job, if you're working hard in society, you'll have lots of excess money. If you're working a good paying job right now, full-time, and you don't have savings at the end of every paycheck, there's a problem. You're spending too much. I don't want to be that guy, but like that's just a fact. You have to find ways to earn more money. You got to work hard, but you got to really work on not spending. There's lots of people making $100,000 a year who don't save a penny. They have nothing. They're like, I have no money at the end of the month. I've been working 10 years in this job and I have no money. And it's like, you make $100,000 a year and you have nothing left over? I don't understand. Like, why can't you just go buy a duplex or go rent a house and then get roommates? You know what I mean? Like, just bad decisions are why people don't have any money right now. They make continued bad decisions. And it's unfortunate because when you make bad decisions early on in your life, you miss out on a huge opportunity cost. Opportunity cost is the idea that if you could have done something with that money and you didn't. And so the opportunity cost, if you choose one opportunity over another, it's like, hey, there's always two opportunities. And when you choose the wrong one, sometimes the opportunity cost of that choice, like I'll give you an example, going to university or college, that is a huge opportunity cost. I took it. It cost me $250,000 to get my finance degree from Ivy. Mostly, not even just from tuition, from the opportunity cost. I could have been working as a tradesman making $60,000 a year for those 4 years. And then at the end of the 4 years, I would have 4 years of work experience in that job. And so in year 5, coming out of college is your year 1, I have in my 5th year of experience. I'm probably making more. So it takes many years for college and university to have a good ROI, return on investment. And the cost of that, say you could have made $60,000 a year for that 4 years, and instead you went to school and you made zero. In fact, you paid money to go for the 4 years. If you invested just that, and no one saved any more money, you just took that 4 years working, you lived like a student, you ate ramen and noodles, and you lived in a room that you share with 5 other guys. You did the same thing as you're doing in school, or girls if you're a girl. Instead, you just took that $60,000 a year you made, plus the tuition and the books and the extra cost. So you're making your salary, you're making no salary, you're going to debt. If you just took that money you would have spent and invest that, by the time you're 65, it's like $8 million. So is your degree worth $8 million? Every single person going to school can have $8 million in retirement if you compound it over your lifetime. It's a significant amount of money. Would I rather have $8 million in retirement? Or let's call it right now $1 million, because my $250,000, and I've been a decade now or whatever, since I've been out of school almost. That's crazy, I'm getting old. I'm 30 now, guys. Ugh. I went to school at 17, right? So I was done my 4-year degree when I was 21, working full time. Anyway, crazy, right? Like how the opportunity cost that the math doesn't support. Even one of the best, I went to like the Harvard in Canada, and it still doesn't, the ROI doesn't make sense. The math doesn't make sense behind it. It takes a long time. You're becoming a doctor, going for your MBA, none of it makes good financial sense unless your pay bump is like $250,000 a year, which is 0.1% of the MBA grads. So if you're gonna be the 1 in 1,000 that gets the dream job, that's gonna have the top 1 percentile in marks in your whole entire MBA class, it might make sense. In which case, if you're that person, what could you have done in that 18-month MBA? Outside, if you had not spent the time on the MBA getting the top 1%, if you'd spent that in not recruiting and all that work, if you just spent that time in your career or on your side hustle business, you could have made so much more money. And people go to school, they say to get a good job. They say to make money. Like that's their primary drivers, right? It's not to like have fun. I'm sure that's a driving factor, tertiary, like second or third reason. But it's just not a good use of capital, you know? Like, it's just not a good use of your time. Your capital input of your time is the most valuable thing that you have. And so, I don't know where that tangent was going, but just be careful of how you invest your time and make good decisions. Opportunity cost is real. And so if you can invest early and invest often, it will pay off dividends. Every decision I made when I was 17 and 18 has to save, say, $10 here, $20 there. That's become $1,000 today, right? And it will become $1 million over my whole life, right? Assuming I live a long life. Okay, let's do some Q&A. I'm behind on the questions. I'm gonna try to wrap some out real quick here. If you get your real estate license, do you have to keep paying the $5K a year? Can you take a break and then restart your license when you need to? So Raz, I'm also a licensed realtor in Ontario. I have to do my continuing education credits, actually. I just thought of that. Every 2 years, I have to do continuing education. It's a pain in the ass. You got to pay money for it and do a whole bunch of courses. Yes, the answer is you do have to continue to pay. If you have a brokerage, you have to pay brokerage fees. Your local L-Star board, if you're in London, St. Thomas area, wherever your board is, it'll have a, you have a Canadian board, an Ontario local board. You'll have MLS costs. You'll have data costs like Geo Warehouse. I have errors and admissions insurance I have to pay. There's significant cost to keeping it alive. I think I pay like probably $600 a month to keep my license up, and I rarely use the license. But it has benefits, you know, like the 2 times a year that I use it, I save $50,000 in commissions, right, or whatever. It does make sense. I probably save 6 figures a year, so it's worth it for me. Can you park your license? Yes, there is a way to park your license. I think you can't get out of doing the continuing education fees. There are still fees to keep it going, for sure. There's no way to park it indefinitely that I know of. You got to keep doing the continuing education to keep it going. You got to keep your membership dues up. There probably is a way to postpone it, but to reduce the cost somewhat, but it'd be such a pain to try to leave your brokerage. There are brokerages who will do a split too, so it might not cost you anything but a percentage of your deals. Good question. Gurinder says, hi Mike, thanks for hosting. Do you know of any government grants for windows and doors? I had a company in London quote me $9,000 for a new front door. $9,000 for a front door? What kind of front door is this? You can go to Home Depot right now on sale and pick up a nice front door with a little glass window in it, pre-hung, for like a basic like 36-inch, 32-inch pre-hung door for like $400 on sale. And then you get a contractor to install it at $25 an hour in like 6 hours. Not even. 1 full day, let's call it. So $200. Do not go with one of these companies. Find a contractor who's $30 an hour, $40 an hour, and say, hey, do you know how to install a door? And if they're a half decent carpenter, they will say, yes, I know how to install a door and put trim on it after. You put the door in, you set it where you want it, you put your shims in, you spray foam it, you cut the spray foam, you put the capping on the outside or trim, you can paint trim, lots of ways to finish it out. And on the inside, you put some casing up. It's literally a 1-day job. Should be $200-300 labor. I'm sure the window and door company is going to make $1,000 commission for the salesman to meet with you. Then $1,000 to go deliver the door or whatever. And then they're going to buy the most expensive door for their $2,000 probably. And then they'll pay their trades guys probably $100 an hour. Plus, you know, they got company overhead and whatever. I don't know how they got to $9,000 for a front door. It's got to be a really nice double door front door maybe or something. I don't know. I don't notice a big difference between like a $500 Home Depot door that looks really nice. See on my stories today, I have a door that's opening at the start of this video. You can check out the video where I'm opening a door to one of our rental units. That's a $500 door. It looks really nice. That compared to a $1,500 door, not a huge difference. Anyway, so 100% to answer your question, do I know of government grants? So that was the first part. Yes, there is a Green Ontario, there's an Ontario program. I've used this program and I've sent probably 100 people through the energy auditors. I've sent so many people, investor friends that I know through these energy auditors. There are programs right now, lots of them. You get, it used to be, I haven't done the program recently, but you used to get $80 a window plus a bonus of $250 per thing that you do. So if you go around and do some like caulking on the outside of your house, you get a grant for that. It's $250. You do your furnace, you get a grant. You do your insulation, you get a grant. You have to do minimum 2 things. So you could do like 2 windows, a door, and foam insulation. I think that would count. Hot water tank too, you can do and get bonuses. You can pick what you want to do, but there are definitely grants. They used to be better. I used to be able to get, back in the day, I had a guy who was super cheap for installing windows, and my grant on a duplex used to be able to get $5,000 and $5,000. If you had like a semi beside each other, you get $10,000 grant plus bonuses. And I could get the windows down for like $3,500. You could actually make a profit off the government. They would pay to really put new windows in your entire house. There were some really sweet grants. Also, the solar programs in Ontario were sick. Like in 2012, I looked at it. I don't know why I didn't put it on the house, but I was like, at the time I was just so constrained for capital. I was trying to grow my real estate portfolio, and every dollar I could put into a down payment on another deal was like I could just double my money. And solar didn't double my money. It was like a 50% ROI. And now I look at a 50% ROI and I'm like, wow. But they used to pay you, it was 88 cents a kilowatt hour. They would pay you, and hydro back then cost 7 cents. So they would pay you 10 times your cost of hydro to buy hydro from you on your roof and give you a grant to put it on. You had to pay some money out of pocket, but like it worked out that you were selling hydro back to the grid at 10x what you were paying to buy it from them. So you could continue to buy hydro for your usage and then sell the hydro you're producing back to Ontario government. And Kathleen Wynne had some horrible, great programs, horrible for the government, horrible for the taxpayer, but really great if you were able to take advantage of them. And it was crazy. Solar was crazy. You could make, like I know some people making $1,000 a month on like a $20,000 investment, which is like 20 months, you get your money back. And you had a solar system good for 30 years. Producing, and it was a 25-year contract. So they're still getting paid today 10x the hydro cost. So they're buying hydro from London Hydro at like 10 cents. They're getting paid like 90 cents to sell their hydro back. And so it's just unreal. And they were getting checks. Like it wasn't a credit on your bill. It was like they were mailing you cash every month. And they're still probably having billions in losses funding that whole program because they signed contracts for 20 years. So just unreal, unreal. And my in-laws put one on their shop. And so I know that they're still getting it. They didn't get the top fee. I think it would scale down over time, but craziness, crazy incentives out there. Use them to your advantage in your real estate businesses. Joseph says, hey, Mike, the market has been depressing for me with high home prices and mortgages, still competing with buyers and little cash flow. What if you have any inspirational, motivational advice? Joseph, it's getting better out there in the respect that like prices are falling, that you know, you're not having to compete with as many people. Perhaps you're looking at the wrong kinds of homes. Perhaps there's the home that I guarantee you, type in motivated in the keyword on Zillow or in your realtor remarks. I look for keywords. So I'll type in like motivated, seller, financing, words like that. You can bring it up. You'll find people put in the listing, motivated seller in the remarks, or even just in the actual listing. And those are the people you want to be calling. Go on and filter by been on MLS longer than 30 days. Stop looking at homes that are freshly listed and look at just stuff that's 30 days or older. They'll have a much easier time. So I hope that motivates you. Like you can get out there and you can offer them 80 cents on the dollar. And some of these houses will actually, some of these offers will be accepted in this market. 20% off, 25% off. So throw those offers out. You can make it happen. So hopefully that motivates you a little bit. Definitely don't give up. This is like putting in the reps. It's like people reach out and they're like, hey man, like imagine if you're working out and you're like, hey, I just did push-ups like for like a week. Every day. And like, you know, I'm going to the gym for like 2 months and I'm just like doing sporadic workouts. Like I'm not seeing results. And it's like, well, one, probably your method is not great. And so like breaking real estate down the same way as I would with a gym workout plan. It's like, and like, I am not ripped at all. So like, I should not be giving gym advice. And I do not do anything hardly at the gym. Like I do calisthenics at home. But when I used to go to the gym a lot, I used to have a program, and I used to be a varsity athlete. I compare it to that because a lot of people understand that. It's like that. You have to create a training program. So your training program in real estate is like, what reps are you going to put in? What exercises are you going to do? Have you called 50 realtors and talked to them and told them what you're looking for? Have you even narrowed down what it is that you're looking for? Do you know what it is you're looking for? Are you looking for the right asset class? Is it something that needs a lot of work? What are you looking for? Is it a conversion project? How are you going to add value to that project to make it increase in value? What can you do to it to make it better? And that's what real estate is buying a business that you can, it's really a business, right? Each property is its own little business. And it's like, how do you make that business better than it is right now? And so that's what I do when I'm looking at real estate. But putting in the reps, throwing out offers is good practice. I mean, you got to throw out 100 offers before you know how to write a good one. So improve through repetitions and practice. Each time, look for new clauses you can add in. Look for, you know, through the art of negotiation, you can, if you love to negotiate like I do, I mean, it can be fun for you to learn and practice and hone your craft. So don't give up. You know, you'll be okay. Inspired by the journey to achieve fire, it just feels much more difficult. I mean, I don't know if that's more difficult. In the smaller markets right now, you can still get good cash flow. So go to a different market. If you're in Toronto, Vancouver, look outside. Don't, you know, be fixated on like this one area. I've learned that it's not that hard to run properties virtually. Especially with the technology that we have today, I can watch a video and it's as good as me being there. If I have an independent third party walk around and do a video for me, it's the same as if I'm there. Like 99% is good. Legitimately. Like it's actually a waste of my time to go to my properties. Even when I'm in London, I don't go to my own properties very often. I intentionally have a $20 an hour property manager go and take videos, and I talk with that person, I train that person, I have them deal with that. Because it's about creating systems. It's about having the business run on its own without you. And I think that with technology today, it's really good. It was hard to do it when I was first starting out because no one had FaceTime. And no one, like the quality of video wasn't good enough for me to see if they had cocked the baseboards well enough. But now it's like 1080p, everyone has a 1080p, 4K. They have quality cameras and it's instantaneous. We can go quick, and then give me a video. Contractor wants to be paid, they send me a full video. Simple as that. I get a chance to go through it. I look for deficiencies. I know what I'm looking for. You can do the same thing. You can learn how to do that. So in a lot of ways, it's easier today to invest in a market 4 hours away. It's easier today to do things that you couldn't do before. And so in a lot of ways, I would say it's easier to do it now than when we did it then. When I first started investing in real estate, my first mortgage was 4%, which like rates were higher actually back then. And even in 2018 or 2019, I remember rates crept up for a little bit. They went up like 1%, from like 2.5% to like almost 4%. I remember interest cost me up like 30-40% and thinking to myself like, oh, it's so hard right now. Like now is admittedly harder. Like mortgages in Ontario right now are like 5.5% on a 2-year fixed. On a 5-year fixed, you're like 4%, 4 something. You can still buy in Canada right now at 4 something. The US has insanely high rates. For some reason, Canada's rates are much better. All the A lenders in Canada don't charge lender fees. Whereas in the US, I'm noticing they charge a lot of lender fees, 1% and 2% lender fees. So that's kind of annoying. That is something nice about Ontario, I will say that. In general, the lending practices of the big banks, they'll even comp your appraisal. Like it's just great. But yeah, it's not that bad out there. You can definitely still make it. There are still, you can get a 4 or 5 year fixed mortgage right now if you're competitive on ratespy.ca or ratespy.com. Rate Hub has it too, but I like RateSpy better. You can spy on what the best rates are. So you can negotiate the rates pretty good these days. So if you work on all those levers, it can still work. You can still have cash flow. You can definitely still make it work. Okay. How much longer will you be in Florida? If you want to come down and visit and help out, Chung, you definitely can. This is not an invitation for anyone. Like I specifically know Chung, he used to live with me. So it's a different situation, but we'll probably be there for a few more weeks. We stay typically December to April, and then I will probably make a summer trip as well, just to check on things, but that's the current setup. Next question. I'm glad I'm getting to watch live for the first time in a long time. Hashtag dad life. Hey Wes, welcome to the stream. Thanks for tuning in. Yeah, dad life. I got 3 kids. I understand what it's like. It's crazy, man. It's crazy just to get a moment to ourselves. Har says, if you had $100,000 cash to buy a home right now, would you wait or would you buy now? It depends. It definitely depends. I think if you're currently renting right now, and there's a way you could buy a duplex and start living for free through house hacking, where you're renting out a portion of the house to cover your living expenses, the sooner you do that, the better. So jump in on that. If your time horizon is forever on that property, and you find a really good, strong, cash flowing property, go deploy it. If you're just buying something to buy something at market pricing, I would wait. So if you're just going to MLS and you're just going to buy something that's not a great deal, you're not going to add any value to it, you're just going to buy something turnkey, I'd personally wait. I think there's more opportunity to come. You're not going to miss out on a lot, so I'd wait. But it depends. There are situations where that might not be the case, right? Also, don't sit on cash. Go deploy that cash somewhere. If you can find a place to deploy that cash, deploy it. If you're a flipper or something, or you know someone you can partner with someone who's doing like flips right now and get involved in something like that where your cash can continue to work for you. And then you can go and buy the long-term asset and get the appreciation when you're buying towards the bottom, where there's actually a good long-term, like good short-term outlook. Right now, the short-term outlook for real estate is not that great. The medium-term outlook for real estate, neutral. So you're not gonna miss a lot. You're gonna get a lot of appreciation by buying now, if that makes sense. You get a lot of cash flow. So if you buy a good property for cash flow, then you're good. What are your thoughts on CMHC commercial financing on new builds? Love it. Love CMHC. They're artificially subsidizing the cost of interest to make it very affordable. You can get great loan to value too with CMHC. It can make sense. If you have really good cash flow in those buildings, that's super important. You need strong cash flow. If it does not debt service really well with tons of positive cash flow, on to the next thing. Okay. Does it always make sense to balance or just hold for long-term appreciation? It can make sense to hold, especially in the United States where, okay, so in the United States it doesn't because you can 1031 exchange. You can just trade that asset in for something else. But in Canada, it makes sense to hold because the tax consequences of selling, the capital gains tax kind of sucks. So I don't know. I think that it depends. If I can get a good price for that asset, everything I have is always for sale. The time and effort to sell is a lot of effort. If I can use that time to get something else, that can make more sense. If I have a really underperforming asset, I'll definitely rebalance. If I've got a property that's worth 750 grand that doesn't cash flow, sell it off. I have a triplex like that to me doesn't make sense. I have to put a mortgage on it for it to make sense, and right now I own it in cash. So that'd be a good example of like, once I finish the permit off on it, I'm gonna sell it off. That's an example of something I would sell, rebalance. It would be a great house hack because it has a detached tiny house, ADU in the back, and the main house is a duplex. Like that's a great property to live in and live in for free. Probably only worth like $699 now, to be honest. It's probably worth $800 at the peak, but prices have fallen a bit. Okay, so I'll answer that question. I gotta go through some rapid questions here. Hi mate, I love some of the mid six figures, trying to time the entry. What do you think is a good time? I was thinking total market index, ETF, 5% a week DCA. Yeah, I think that just start buying a little bit now on the red days. So days like today would actually have been a good day to nibble. And buy a little bit of the indexes today. Like the Dow Jones was down over 500 points today. The S&P 500 was down almost 2% today. So that'd be a good day to nibble. And I think days like that, you continue to nibble on the red days. And there'll be days where it goes down further. But over the long term, you'll win. Big time. Bum, bum, bum. Next question was, hey Default, how you doing? Brandon said, Alan says, hey Mike, what are the top 6 banks and credit you, except Big 5, would you recommend for unsecured LLC to invest in? So you're asking what are the Big 5 banks? So Alan, in Canada, there are only, like, you don't know what the top banks are. So they're like TD, CIBC, RBC, BMO, Scotiabank. I don't know who I missed. I'm sure I've missed someone. And the big credit unions are like, Meridian is the biggest in Ontario. There's a couple other smaller credit unions like Libro and then London, Ontario area. Van City is huge in Vancouver. They're a big credit union. I'll go on the next question. I'm running out of time here. But yeah, definitely go apply for some unsecured lines of credits. They're going to be harder and harder to get with this credit crunch going on, but definitely go apply for them, 100%. I would apply for them all at once, 100%, because then it doesn't show up on your bureau for like a month. So you can get a whole bunch of lines of credits all at once. And if you wait, you won't get them. You apply for one, then wait to apply for another one 2 months later after it's approved. They're going to say, you have a line of credit over here. We're not going to give you one. So just keep that in mind. Brandon says, just tuned in to start. I've had 100 people message me for a rental. I've done a lot of showings to avoid having a bad tenant. Probably just do student rentals again. Just hate looking. Yeah, Brandon, it's tough, man. Like, just in general right now, it's difficult to find a good tenant. There are so many bad tenants out there that you have to be very diligent to avoid them. For new tenants every year or two, just got to outsource. Yeah, I mean, that's another play. There's also the Airbnb short-term rental play. There's also, like, you could just talk to a really, like, a good quality tenant that I love to find is someone who's looking to buy their own house. And it's like, if you're planning to buy a house, they have lots of investments, good credit score. They probably won't be in your rental that long. They're not going to be lifers because they're planning to go do something with their life, buy a property. Next one was, how can every citizen be rich? Don't you need to be poor to work for the rich? It's like you can't have good without bad. So Raz, no, you could definitely have an elite society where you could think of society, like utopian societies where, there's a really good article, by the way, on this that Mr. My Mustache did. And it was like, I think he called it Badass Utopia. And it was talking about what if everyone was like a mustachian. They were super frugal, they found financial independence, they're just living off their investments. Basically, my theory on this is that in today's day and age, technology can do a lot of the hard work for us. What you will see is that the people who are, you're right, in a perfect society, we would need AI or robotics in order to ensure everything runs smoothly. What we'll find is that in a society like that, a utopian society like that, people would all volunteer. They would all do something with their life. Like they would want to, let's say like you really enjoy like working with wood. You would be the guy who's that job, right? So what you'll see is that even when they're financially independent, people will gravitate to doing something. And so society will still function in that way. But the jobs that no one wants to do, you outsource, and I guess the market will demand. So if everyone was super smart with their money, the jobs that no one wanted to do would pay really, really well. And so hopefully you have an equally distributed age gap in society, and so that your retired folks who want something to do, and you got your students and your people who are in their financial independence grinding journey. Those people will work really, really hard, and they would carry society. So there's always a segment of society that's working towards financial independence. But yeah, once the people who have financial independence, if they all just, their capital can produce enough for them to survive. Totally. There are societies that are rich enough that they could afford that every citizen in that country would be set for life, so to speak. So if you have enough assets, you could, now that it requires exploiting the third world, and like again, the philosophical on that, but I guess if the whole world was financially independent, who would do the work? We would need robots. You're right. It can't. There can't be everyone in the top 1%. If there was, then the cost of being in the top 1% would rise. And so then the best would fall from the weakest. I happen to be someone who is a hyper-productive person. And so no matter what society you put me in, I will thrive. I will climb to the top. That's just who I am. And there are people like me who, like, I would never do well in a communist society, because to cap me would be to tell me, hey, there's no incentive. You're twice as productive, but we're going to be no more incentive. Like, what? Anyway, I don't want to get into politics on that. I don't hate communism either. Like, it's probably good for society. I just believe that people are inherently selfish, and that's part of why communism fails. Nathan says, when I was 18, I wasn't thinking of retirement. I was looking for any purpose at all. Fair enough, Nathan. I mean, there's definitely, I was also lost at the time. And so if you can dial in and just like work a job that you don't necessarily care about, like plumbing or like some random contracting job, and it's like you're trying to find yourself still, but at least you're saving everything that you're making. And then in the future, you can do whatever you want with that nest egg. It's like almost, it'd be really nice if the government was like, hey, we're going to take 50% of all of your earnings from when you're 18 to when you're 30 and put it in an investment fund for you. It's a 50% tax, but we're not going to spend it how we want. We're going to take all of it, mandatory, and buy the index. We take no management fee. We do it for free. Or take 50% of your income or put it aside for you. Every single person, if they worked a full-time job, would be millionaires. That'd be amazing if we had that sort of surplus funds. We just took some and set it aside. People would like that, I guess, because they want to spend everything they have. I know lots of people who are like, I can't save 5%. You can't force me. It's like the guy who eats all of his acorns, and then like winter comes and like, could I have some acorns? Man, like I didn't save any for myself. Citizen says, can anyone recommend a good investor or realtor that can help me get a place in the immediate surrounding area? I can recommend a ton of different realtors, for sure. William says, let's see some likes for Mike. Thank you, William. Definitely with 22 likes, let's go get this up to like 45 or 50 likes right now real quick. 50 people on here, 50 likes. Sam says, hi, Mike. You mentioned throwing out lowball offers. I saw a great property and had a realtor who was really reluctant to put a lowball. I work with multiple realtors, by the way. I have realtors in every town, and if someone brings me an exclusive listing, I work directly with them. I will never sign a buyer's rep. That's just me. I've always worked with multiple realtors. I know realtors don't like that, but that's a good way to operate, I think, is to have multiple, realtors in different zones, I guess. Like I would divide up my city. Like, there's a realtor who's really good in the East End. He'd my East End realtor. If someone in the West End, they're a West End realtor. I have different cities. I have realtors in different cities that do things for me. I have different types. Like if I have a student rental realtor, and then I have a realtor for my luxury stuff, and then I have a realtor. You can have realtors for different things. And so people think you just have one realtor. It's like, no, you should know every realtor. In your market, you should know every realtor in that market. In London, there's probably 5,000 realtors. You should have an Excel spreadsheet with the 5,000 realtors and have touch base with every single one of them. If you haven't done that, you're not a proper real estate investor. I haven't even done that, especially recently. There's probably a couple thousand new agents that I haven't talked to in the last couple of years. I should know all of them, and they should all know me. That's part of succeeding in this business. It's a networking business. Opportunities come, and it's two people who know each other. If you don't know that agent, you'll never know that opportunity. It may not even hit the market. So it's super important to network in this business. That's what I love about it, is that, again, markets aren't efficient. In the stock market, there's a set price. Everyone has access to it. In real estate, Granny's house goes up and no one has access to it. There's a flyer they sent to 10 clients and no one else knows about it. Didn't even hit the MLS. And if you're in the know, you can bid on that house and buy it for under market value. You can go buy Apple shares at half price. That's the real estate market. That's the business world where you can take advantage of opportunities. Someone wants to just retire and sell their business. You can buy their business off them for 1x earnings. That's real. That happens all the time in the private market. And if you're the only person that's in connection with that business agent, you're gonna get that lead. Hey, super chat. Cool. Ken Klassen, thank you. Celebrate the super chat from Ken Klassen. Thank you so much, Ken. I appreciate the super chat, keeping the channel alive. There is also, I'm just gonna take a second because there's 50 people watching and 1,000 people will watch this replay. If you're watching this right now, there is now a function on my YouTube channel to join a membership and support me. And I'm gonna make rewards for that. So if you guys go out there and you support me on a monthly membership, YouTube probably takes half of it, whatever. But it'll tell YouTube that I'm a valuable channel. One, it'll promote more of my content. But two, it'll generate some revenue that we can use to give back to you guys in some way. So if there's something you guys want, I might do like an annual like private stream where we do like, we can analyze deals or something. So that's coming. Actually, it is already there. I think you can already subscribe for it. So go subscribe to that. I don't even know what the prices are, but I turned it on. There's an option in my YouTube channel to do that. So yeah, definitely go subscribe to that and that'd be cool. It would mean a lot. It would mean a lot. Ken says, I'd like to buy a rental property in Florida before August of this year. I don't have any US credit. I don't know what area to buy it. When you say is a good time, how do you find people to trust? Ken, send me a message. He says, I have cash. I have 200,000 in cash, looks like, or that's what you're looking at to buy. Ken, send me an email at rosehartcapital@gmail.com or rosehartcoaching@gmail.com, and I would be happy to point you in the right direction. I know some realtors here that I can help you out with, and we can kind of go from there. I can give you a hand. No problem. Happy to help. Inna Travels says, not business related question, but do your children get sick in Florida as often as in Ontario? My kids get sick all the time. It's just, unfortunately, like my kids get into everything. And I've got a young baby who, like, we go to the library as an example for like the playtime, and she'll just touch everything. I'm sure she like rubs her face in it after, and it's like, right? So that's just the nature of the way my kids are. They definitely are like in the dirt kind of kids, which is great for like their immune system long-term, but it's horrible for getting sick. So yes, they get sick. There is a study, if you're talking about the heat versus the cool, that breathing in cold air actually reduces your efficacy of your nose in fighting bacteria. There's actually a great study on it, where it's actually proven now, if you go through extreme cold and then expose yourself to airborne illness, your nose has a worse chance at fighting off and not getting that, like you will get that cold more likely. So the cold does for sure reduce your ability to not get airborne illness. That's been studied and proven. So heat definitely helps a little bit. But I mean, my kids are wild. They go to the parks and they, you know how it is. Do they get sick less? I don't know. My daughter's out of school, so probably a bit. Welcome to private Rosehart access. Hey, just a guy in a van just joined. Welcome. Thank you for joining. That's cool. I think you're my first ever member now in private Rosehart access. I'm gonna get you some cool stuff here. What can I do to... There, I made you a moderator. There you go. Cool, now you can moderate chat, I think. I don't know, I just clicked on you and gave you moderator privileges. I don't even know what that does, but congratulations. Thank you for joining the private access. Okay, next question. Okay, so throwing out lowball offers, she wouldn't do the offer. Back to Sam's question there. I don't know why she wouldn't want to put an offer in. So Sam, the reason for that is that a lot of these realtors, they want to be effective with their time. And so sometimes, or most of the time, I call and I talk to the agent and I say, hey, we're willing to put in 10% under asking. And I do it verbally and I feel out the agent. And if the agent's like, that's not gonna fly, depends on the property. If I feel like the seller's motivated, I'll write it up and I'll put it in their hands. We give it a shot. Sometimes the agents told me, no, the seller will definitely not take that. And we put it in the seller's hands and the seller's like, a counter 5,000 more and we'll take it. So you'd be surprised if you present an offer, if your buyer's agent presents an offer to the seller, the seller's agent has to bring it to the seller. They have to show them by law or they lose their license. So there are agents who won't show the client their offer. They have to. So first off that, but you don't want to be hostile, but yeah. You definitely would want to find a realtor who's newer. A realtor who doesn't, like if you're a realtor who's very experienced and been doing this for a long time, you don't want to be throwing out 20 offers. Like I get that. I know some realtors like that who are like, dude, I'm not going to throw out offers like that. It's a waste of my time. Like 1 in 20 are going to be accepted. It'd be like a $20 an hour job. But there are new realtors out there who will do that, who will take that business on. And so find someone who will. There's definitely another agent who will, 100%. If you don't know someone, I know someone who will do that for you. So reach out to me. You guys have my email. I know new agents who are hungry for the business who will do it. Default says, should I refi my mortgage to cover negative cash flow for 2 or 3 years? It can make sense if you really like the property and long term there's a reason to keep it, or a tax reason maybe. It can make sense to carry through negative cash flow periods until things get better. They will eventually get better. So yeah, it can make sense. Depends how much the cash flow is negative. Sam says, so I need to screen a realtor for working with investors? Yes, 100% you do. And then says, I still understand why they wouldn't put the offer in. Again, it could have been that they just weren't that hungry for that business. They're not the right person to be working with, probably. Yeah. Change your realtor to investment-minded realtor. Daryl's 100% right. What's a good rate to get now? Would you say variable or? So I have a lot of variable rate mortgages, but I'm fixing it right now. I like the 2-year fixed product the best right now. You get a 2-year fixed for 5.5% interest right now in Ontario. And the reason I pay more for the 2-year fixed, 2-year fixed, 5.5%. The reason I do that instead of a 5-year, it's like at 4%, is because I believe rates are going to fall. And the nice thing with a 2-year fix is you get in Ontario, you get auto renewal 6 months before for free, no penalty. So at the 1.5-year mark, you can break out and refinance, no penalty. Or you can ride it all the way to 2 years. So if it takes a full 2 years to get rates down, you can wait the 2 years. But if rates have fallen a ton at the 1.5-year mark, you can go refinance into a cheaper product without an appraisal, without another application. This is a myth. People, for some reason, think that you have to requalify. It's like if you had a good job, you quit your job and you have 10 mortgages, guess what happens at the end of the 2-year term when they renew you? They send you a letter and say, here's your renewal offer. And they give you a rate. And you can call in and fight it. And call in and say, hey, you guys offer me 1.84. I'm going to take my business elsewhere and refinance elsewhere unless you guys give me 1.64. And there's no appraisal. Nothing happens. You just call, negotiate, and they give you a new rate. It's done. Your mortgage payment changes. And you sign some paperwork at the office. That's it. So something to throw out there. Definitely want to be negotiating your renewals. You don't have to requalify. So even if you're a bum with no job, they have to renew you. They have to give you an offer. So that's a cool thing in Ontario. People don't know that. Will says there's a lot of scummy So to answer your question, I like the 2-year fixed right now, but it depends on what your banks are offering. Some banks are offering really good discounts on variable. Most aren't. Your prime's at 6.7 right now. You can borrow a 2-year fixed at 5.5 right now. I would go that route because I think it's going to fall. I have some stuff that's still variable right now that I'm holding on to. But Will says there's a lot of scummy realtors out there. Sam, I've dealt with many of them, myself included. There's a ton of scummy, uneducated realtors out there. You have to filter out the good ones and find the ones that make the most sense. Most success with investor-based realtors, myself included, same way. Okay. Oh, we got another person joining. Jeff, how you doing? Welcome to Private Rosehart Access. I can see you in the chat. I wonder if I can write off Private Rosehart Access. You for sure could. This is for sure a legitimate business expense. This is coaching. I do group coaching every week, 52 sessions a year. I mean, if it costs you even $52, that's $1 a session. At $520, it's $10 a session. $10 a session for coaching? I know people that spend $50,000 a year, a lot of them, that join mentorship programs that spend $2,000, $3,000 a month and do it for years. So yes, 100%. You can go in, you can join the private access. There's so welcome. I don't know if you guys can see the chat. It might be also a private chat, which is cool. There we go. I made you a moderator too. There you go. There's probably another level I could give you too, which is cool. This is fun. I'm having fun with this. Holy, look what time it is. I gotta go put my kids to bed. Thank you guys so much for watching. I really appreciate it. Let me go down the Q&A here and see if I missed anyone. Tons of value from your content. Thank you. Thanks so much. Appreciate you joining the channel. It means a lot. Will, there's definitely a way to do it. You have to go into YouTube, probably click on my channel somehow. Someone else would know how to do it. There's definitely a way to do it. On my end, I turned it on, so if you want to join the channel, cool. If you're watching this, hit the thumbs up button. Thank you everyone for watching. We've been an hour and 15 minutes tonight. I don't see why it wouldn't be a business expense. If you bought it with your business credit card, I think it would be definitely a business deduction. I think that would hold up. It's education. It's consulting for your business. That's what I do on here. I mean, there's so much value. I 100% would write it off. There you go. Scroll right under the video, someone says. Hit the like, thanks. Hey, no problem. Thanks, guys. The secret to unlocking wealth, here you, There's 3 levers and control your financial future. Spend less, earn more, maximize returns in the difference. That's it, everyone. Have a good Wednesday night. We'll see you next week. Remember to follow me on Instagram, Mike Rosehart, Facebook, Mike Rosehart also. Yeah. See you guys.